Use Emirates Virtual Investment Challenge for 2026. We have an exciting session for you this morning. We have our trading veteran, Michael Grobler, who is going to take us through all 30 of the Dow shares that you can invest in. But without further delay, let me hand over to Michael, and he can start a session with you. I will make the recording available to everyone. And of course, please be sure to follow us on YouTube so you can get updates of all the new videos we post.
Good morning, everybody. Let me just share the right screen for you quickly. Okay, so today we're going to have a really nice chilled one, just some fun stuff, nothing too academic. Just have a look at the heat map of the market. I'm going to teach you how to read a heat map. Excuse me. And the reason why is because it happens to be earnings season, which is the most exciting time in the market. It's more important than wars and oil and all the other stuff, because at the end of the day, this is really what drives share prices in the long term. I'm going to show you how to differentiate between the stocks you can access and the stocks that you can't for the purposes of this Emirates competition. So we'll start off with the TradingView heat map, which is just a way to look at how every session or a period of sessions has gone for a number of stocks, and to see them quite contextually. I'll explain how, but let's start with the website itself. All you need to do really is type into Google TradingView heat map, and it'll lead you to this little website here. TradingView is a really useful tool. It's a free tool, 100% free. We've referenced it many times over the years, and it's just a great tool for you to have in your toolbox. It gives you charting, it gives you price movements, it gives you sector breakdowns, and it's just a really clever and intuitive system. And pretty much everyone in all of investing uses it, no matter what scale they're at. So in this case, we're looking at the S&P 500, but that's 500 stocks that are the largest 500 in America. So what we'll need to do is we'll need to just bring this down to the Dow, because this is the group of stocks that forms part of the competition's qualifying stocks. So yeah, you'll see quite a number of these. They're all just different measurements. The composite is just the combination of the others. The one you want to go to is called the Dow Jones Industrial Index. That's 30 different stocks. They aren't always the biggest 30 stocks, but they're the biggest economically impactful stocks in America, essentially. It's created by a guy named Charles Dow. Many years ago, he founded the Wall Street Journal, and then people were trying to figure out a way to track the stock market, because you could, in those days, you could track the stocks, but nobody came up with the idea that they should have some sort of measurement for the overall market so they could track it year after year. Charles was the guy. So you can see here just a couple of things that you can just learn by looking at a Dow heat map. So you can see that computer companies and IT-related companies like NVIDIA and Apple and Google and Amazon and Microsoft are clearly the largest types of companies in America. And if that's the case, and America has the world's largest companies, then these must be the largest companies in the whole world, which they are. You then get other famous, massive companies: Walmart, JP Morgan, Visa, Johnson & Johnson, Coca-Cola, Procter & Gamble, United Health. And you get energy companies like Chevron, you get consumer-facing companies like McDonald's and Disney. But here you get an idea by virtue of how big this block is, how large the company is relative to the other companies in the stock market. Here's Boeing, BA. So it's actually quite cool to think to yourself that Chevron, which is a massive oil company, that actually goes and digs out black gold from the most dangerous parts of the world, is a fraction of the size of Google, which basically sells information, hot air, airtime, whatever you like. But really, it's a fraction of the size of this technology company. Apple yesterday, ironically, by virtue of the fact that its share price has done fairly well lately and Nvidia has had a bit of a harder time after having a very good year last year, Apple has surpassed Nvidia as the largest company in the world again. These three love to compete. Microsoft also used to compete, but it has had a bit of a hard year. So looking at the movements over the course of the session last night, you can see it's a one-day change. What if we took that to year to date? Okay, so now it's a very different story. Now you can see that you could argue you were going to buy technology companies, you would have done fairly well, but had you put a majority of your money in Microsoft, that one would have knocked you a little bit. So it's been a good year overall-ish. I mean, this is not really, I mean, you think of Nvidia, you think of having far larger returns. So Nvidia's had a very slow year, whereas Apple's had a great year. And this is why Apple has been able to surpass Nvidia again as the largest company in the world. Google's done okay. Gemini's doing pretty well. But some of the Chinese models these days are starting to concern these companies. Amazon's also done okay. But retail hasn't done terribly well in America. If you look at Walmart, if you look at Target, this is HD for Home Depot. Health technology did pretty well for the year. Coca-Cola, Procter & Gamble, the things people can't really live without, they did okay. United Health had a great year, and it also had a decent second half of last year. It's had a couple of rallies, but here we can see, with the exception of Cisco, is it Costco or Cisco? Let's look. Depends on the day who makes it into the Dow, and those companies are, in this case, it's Cisco. So Cisco's had quite a decent time this year, being in the information technology industry. Look at these movements. It's been pretty unbelievable if you think about it. Now, this has been largely the result of the AI theme that's been obviously taken over the market. I don't think you need to be a trader to imagine that that's happening in the market. But you can see that it's obviously very much increased the, I wouldn't necessarily say it's increased their profits, but it's increased the expectation of future profits by the market of these companies. If we look at Nvidia and see that this is quite a good example of what's been happening lately. So it had a pretty great run, to put it lightly, but it's having a bit of a pullback at the moment as people sort of start to digest the whole AI. How big will it actually be? Little bits of news have been coming out about how companies that we call hyperscalers, companies that have been building a lot of infrastructure in anticipation for AI taking over the world, they've found that the demand for that infrastructure is slightly underwhelming. That's gotten the market a little bit nervous, because the whole idea behind buying Nvidia and buying these hardware stocks was that the market was somehow going to continue upward in an almost open skies trajectory based on efficiency improvements and new technologies that are unlocked by AI. Now, whether it's the AI or the new pricing that AI has started to experience, there's been quite a substantial increase in pricing due to a change in the models, the way that they charge their customers. So this got people a bit nervous about monetizing this technology in the future. You know, you've got people paying up to 1,700 Rand for one subscription to Claude. It gets a bit unsustainable if you're trying to build companies that are spending trillions and trillions and trillions of dollars, literally trillions of dollars on infrastructure. And if nobody can afford the AI, it's a bit concerning. Microsoft is going down because they've not been terribly successful with Copilot's integration into their systems. Again, this company was expected to make quite a lot of money out of AI, and it's turned out a bit underwhelmingly. Apple, ironically, is probably the stock that invested the least in AI. They sort of gave up the ghost with their Siri software and never really tried to compete with Gemini or even Grok or OpenAI or Claude. And they've been rewarded for not blowing the capex, basically. This was going to be a very expensive race to whatever form of intelligence they were chasing. And the question was, would you monetize this technology before your shareholders start asking, you know, what's going on? IBM, let's have a look at that one. That one had a very interesting day this week. The reason being, it came out with what were considered to be disappointing earnings. They weren't bad. They were just very disappointing to the market. And now you know how big this company is. It's IBM. Everybody knows IBM. And it had an absolute shocker of a candle this week, a 25% drop on a mild disappointment in earnings. The reason why I tell you this is because these companies that you have the opportunity to buy, you're going to look at their fundamentals and you're going to look at their technicals, you're going to look at their charts, but always remember above all sentiment. And if you don't have a lot of experience in the market, it's hard to figure out what the sentiment on each stock is at the time. The chart will give you an indication if it looks really like, I mean, if you think about it, in June, here's June. Here's June. In June, this company was flying. And almost instantly, it got wiped out. Because if these narratives, not if they fail or not if they completely unravel, simply if they falter, because of the nature of how professional finance people calculate future earnings, a small change in the growth variable has an enormous impact on the discounted present day cash price of the stock, or what that analyst believes that should be. So if you go from a profit margin of 33% to a profit margin of 32%, that could actually justify your stock going down by 10%. I happen to have this Netflix earnings open to show you another example of this. Just yesterday, because I bet everyone in the world that's listening to me right now has a Netflix account. So this is something that everybody gets. Revenue for the quarter was up by 13%. Now that might not be fantastic, but hey, if you're growing by 13% every year, you're doing just fine. Then Okay, GAAP is generally accepted accounting principles. EPS, so earnings per share. So this is the revenue and this is the earnings. Simple as that. How much of that revenue did they manage to also grow into earnings growth? 11%. Not bad at all, right? Especially in America, where, if you had a fixed savings account, you'd be getting 3% if you were lucky. So this is a very fast growing business. It's obviously in a very dominant position. It's probably going to use AI to cut costs. They've already said they've created hundreds of hours of their new content with AI. Fascinating stuff. So this is what happened when they released those great earnings. A 10% share price drop at the open. So I show you this to indicate that a lot of people are, I actually, again, I often reference mates of mine because they're in different parts of the journey. And one of them came in and he sort of had the silly idea that if shares came up with good earnings, they'd go up. And then if they came out with bad earnings, they'd go down. And then all he'd have to do is figure out which way the earnings would go. And he figured out which way the earnings would go. And then he still didn't make any money because of this situation with IBM or Netflix. And believe it or not, you can have situations where shares come out with negative 25, negative 20, and the stock will fly higher because the market was expecting negative 35, for example. So it's all fair and well to look at statistics and metrics and information and charts, etc. But if you don't get an idea of where the market's expectations are, you really have no idea what you're doing, because the other things are they're essentially irrelevant if you completely misinterpret the market's expectations. So you can see here that Microsoft's down 18%. So the question is, why is it down 18%, but everything else has obviously had an okay time? So that will give you an indication that the market the bottom didn't fall out of the market. So what's Microsoft's problem? So what's Microsoft's problem is that in the past, when the share price was going up, MSFT. So sometime in the past, let's let this thing update. Just a second. Microsoft's chart looked like this. Let's just block out that last bit. So when the market had the chart at this point, it had a certain level of expectation. Now, it doesn't take a rocket scientist to see that that was pretty high at the time. Then we had, now we're sort of, what date is this? Sort of July 2025. So now we're hitting the high of the AI positive energy feedback loop. So boom, everyone assumes Microsoft's a huge industry player. It's dominant, pure evil, all of that kind of thing. They're going to take it over, centralize it, make the best of it. Plus, they're probably going to use the AI to cut half their programmers, which they can replace now all of a sudden in 5 seconds flat. Wonderful. Then the reality sets in. Boom, smashed. Why? And we see it here. Because they failed to do it. So now the market's little illusion in that specific scenario has popped. That's how bubbles pop. They don't go the whole market wipes out everything. You see little holes here where IBM disappoints, and they're supposed to be a big player that really knows what they're doing, who's really going to benefit from the AI thing. And how high are these expectations exactly? Can we get some kind of a quantum of these expectations? Well, this is like $100 billion company that lost 25% of its value. And this gap here is a very big indication to you as a trader. There wasn't a single guy willing to buy the stock here. Not one soul on this whole earth of millions and millions and millions and millions of traders. Only here would they look at it again after the earnings. So that's what they mean when they say the bottom fell out. It really did. People will tell you about stop losses. They'll tell you, okay, well, you should have used a stop loss. Let me tell you why a stop loss is a totally useless thing. Because imagine if you were in this trade. Let's go to an even shorter time frame. This is just some advice, because I promise you of 90% of the videos that you expose yourself to on the matter of trading will suggest that stop losses are a clever idea, and I'm going to tell you why they're not a clever idea. If you were going to make a trade and you had, let's say, for example, 10,000 Rand in total in your life, that was your money, that was your trading money. So let's say that little block constitutes 10% of all your money, and that's what you want to have in IBM. So you make an investment into IBM somewhere around here, for example, and IBM starts moving higher, 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 higher. Now you've made this investment with this stop loss in place, right under this point. But you don't know that yet. You've entered the trade here. You want your stop loss to be at your entry point. So you're like, okay, cool. So we're going to go. Boom. Now you're riding your little profits. Everything's going okay. And then all of a sudden, the bottom drops out. Boom. Now, had you done this trade with a stop loss, you will have put the full 10% of your investment in. But being mindful of the fact that stop losses don't actually work. And why don't they work? Because they rely on another party still taking your stop. So it's not just some magic button that you press that means that the second the share gets down to your failure price, you're going to exit it at a small loss. No. None of these stops worked. Only stops that started at this exact point worked. Because it's a market. You have to have a guy or a girl on the other side. You can't just expect there will be. What if variables change so much that the old situation is simply no longer applicable? All the mathematics of the previous situation, all the trades, they're canceled. They're no longer relevant. These guys have just discovered the cure for cancer. Next thing, you can't even see the chart. It's so up. So this guy, if he knew that stops were not a truly guaranteed means by which to be safe, he would not have made, if he did not know, he would not have made this block so big. If he knew his true exposure to risk, he would have made the block this big. Had he had a genuinely guaranteed exit strategy or what's called a guaranteed stop, but that's something you pay your broker for. If you want to make sure you get your price, you've got to pay. If you're like the rest of us, this guy's going to make a big trade, 10%. Maybe he's really sure that the trade's going to work, so he makes the trade 20%. But he would never dream of losing 20%. He sets the stop loss to be only a 2% loss of the 20%. Okay? Pretty big, actually. 10% of your money. But he's happy to lose 10% of 20,000 bucks. But then what ends up happening is this thing goes down here. And yeah, he's lost way more than 10%. But he went into the trade with the mindset that he would only be risking this. But it was a lie. He was actually risking it all. That's why stops don't work. You can use them, but remember that if you do, you must still scale your trade as if the stop was not there, or you will ultimately find that you will encounter a stock like Steinhoff or a complete catastrophe scenario. Now, this is 25% down. That's pretty catastrophic, but trust me, it's nothing. Way worse things have happened to stops than this. Plus, this is still a decent business. You know, these guys have got a very good chance of ultimately getting it back, but it'll take some time. But the point is, be careful with stops when you're using them in real life. Okay, so now we've got these companies, and I just want to break it down to the ones that have moved the most and the least, and just show you a few things of how you can use this platform. These little numbers down here at the bottom, they are extent of moves. So some of these are pretty epic and some are pretty boring. Like, let's find a boring. Look, this, you know, okay, 3%, who cares? So let's get rid of everything that's not like a pretty extreme movement. Whoa, okay. So IBM's had an absolute shocker of a time, and so has Salesforce. So these are two technology companies, and Apple and Cisco have had the best time, and they're also two technology companies. Interesting. But they face very different directions in the market. IBM is sort of more of a software and hardware kind of style company for actual computing. CRM is a large software services company that they just do software services and cloud, that kind of thing. Apple is Apple, and Cisco, you know, is just a technology company, but again, more in the picks and shovels of the AI. So these guys were like enabling AI, and the IBM and the Salesforce were going to get eaten alive by the AI, apparently. Then you get poor little Nike down here, which is it's probably the most sold off Dow share. Let's look at it. Question is, so I think a few people will end up buying this because it kind of looks like that, which is interesting. It's clearly not had the best time, although it has formed a bit of a base here, so we'll see what happens. But this is probably the dog of the Dow at the moment. Remember, at the top here, you can change your candles to be monthly, weekly, or daily. Here's another great example of earnings that came out, and you had a giant gap. So anyone who was being clever and thought, hey, I'm gonna buy it here, hope it's gonna bounce up, but if it doesn't, I'm gonna put a stop loss in. So this individual watches the stock fall, watches the bounce, watches the stock fall again. And then over there, on this candle, on this black candle, on the retracement to this low, this person wants to buy. Unfortunately, it didn't work out. But it does show you that another leg of buyers has been disappointed. So this stock has been very, very disappointing over the last few years, and it's in contention for the most famous brand in the world, which is interesting. So I think that there is some value in this position, but they have faltered in the past. They try to change their business model from making use of vendors who used to promote their products to a more direct online sales approach, which was pretty popular at the time. It was very sexy, slick corporate action to do that kind of thing. And turned out the people liked the personal experience. And now they're busy trying to walk this process back. And they have been for quite some time. So it's a full-on turnaround story, this. Company won't go bankrupt or anything. It's a healthy company from that perspective. But will it do well in the future? Will it do well for the term of the competition? Difficult to say. But what is interesting is that given I mean, look at how negative the sentiment is. If we just look at this particular Dow constituent, we are now 57 bars, and it's a month, a bar. That's a lot of time for a lot of people to sell a lot of stock and lose hope. So one day, the day will come when the sellers run out. Because remember, buyers can't run out, but sellers can run out. Now, the way we looked at this when we were looking at Microsoft and how it disappointed after this stellar move here, then we had the last of the hopefuls double top it, and then they all got wiped out. Basically, this is quite funny because if you look at this, what happened here, I can tell you already. The clever people got in here and they made a lot of money. Then they sold their stocks at the top, and they sold them to the second group of people, who are the people who are not the clever people. They're the people who were late, but they FOMO'd. So the really clever people sell it to the fake clever people, and they get wiped out. That's called passing the bag. And that's why you generally get double tops. The guys on the left deserve the money. The guys on the right deserve their losses. So the same way that this very positive sentiment leading into what it was, whether it was earnings or whether it was just news articles coming out showing that the AI wasn't such a big money spinner for them, or the fact that co-workers, you know, let's be honest, who uses, unless you are specifically using Microsoft dedicated, and you're quite well educated on the topic of Microsoft. So it's useful in that way, but I don't think it's the primary AI that most of you would use when you're lying on your bed looking up some random topic, So the same way the same way that this disappointed terribly after years and years of positive momentum and a heck of a big build-up of media attention and just all the promises. I mean, just think about the context and the zeitgeist of the time. It then disappoints. So now let's look at Nike. Nike is the opposite. Nike is a total dog, but if anything goes right for Nike, it will surprise, the movement will surprise substantially to the upside. Furthermore, if bad stuff happens to stocks that are like this, generally they have a slightly I mean, if this had to come out with a 1% margin drop compared to last time, it's not going to suffer the Netflix style collapse or the IBM style collapse because everyone is already tuned to the thing being a piece of junk in the market or disliked in the market. So do you see how it's all about the chart? Yes, it's all about the company, it's all about the fundamentals, but if you don't get the overall context of the sentiment, you miss the opportunities. Because if Nike came out with anything positive, surprise sales in China, and remember, this is a company that's in 100 countries, so anything decently, substantially good happens anywhere. They make a deal to become the official Apple iStore shoe, or you never know. I mean, I promise you, it comes out of absolutely nowhere. I'll give you a perfectly good example. This one happens to not be on your wish list because it's just too small now after being totally annihilated. But this is PayPal. Now look at this glorious trading experience over the years. What has happened to this poor thing? Okay. So back in the day, in like 10 years ago, it was the greatest thing ever made. And then it actually received a buyout offer, which it turned down, and then things just didn't go well. But the irony is the company's financials are absolutely not reflected in this particular chart. The company has increased its revenues more like that chart up until this very day. Its cash flows are $6 billion a year, free cash flow. It has enormous profit margins. So this thing was going, and I mean, you can just imagine the absolute negative sentiment. They also thought it was going to get eaten by AI and maybe eaten by other players. And then this very week, it received a buyout offer that sent the share price up 10 or 20%. So if you think about it, you put your money into a savings account, you're going to get 7% for the year. Put your money into something that has a very negative sentiment at the time, but it's fundamentally a good company. Or even the nice part of this whole line of thinking is it doesn't even have to be the best company. It just has to not be as bad as everyone thinks. AI doesn't have to be a failure for the software services companies to still go up. Adobe doesn't have to go bankrupt for Claude Code or Claude Coworker to be a useful tool. It doesn't have to be one or the other. You don't have to be right and your friend is wrong about this concept. The point is that it's easier to get a general idea that a stock is very badly sold off. Then we take that, couple it with the fact that it's a decent company, and you've got a very, very good chance of returning good returns in a short amount of time. It might take 2 or 3 or 4 months, maybe even a year, for a stock to finally come out with that good news. It's not important how long it takes. What's more important is how much the news moves the stock by when it ultimately comes out. Here's a good example. I think we've only ever really made one pick on this during the years, and it was this one last year. It was our friend United Health, which has now reached the middle point of its entire fall. We were speaking about it down here in 2025. This was a company that was totally wiped out. Now, this is technically the largest insurance company in the entire world. This is the sort of the Discovery, Bonitas, and along with every other form of insurance company you can think of, all in one in America. This is the one that they all get their insurance from. The biggest insurance health provider in America. And also, if we go back to our heat map, it is the only health company that's big enough to qualify. So it's far larger than any other healthcare provider in America. Now, just think about how epic that means this company is. So it had its little wipeout. Now, remember earlier on, I told you that, yeah, you had a bunch of guys selling. They were the clever guys. They were selling because at the time the earnings were going down. They weren't good. So these clever guys were selling. The stock then popped higher. This is a monthly. Let's just take it down to a weekly. The stock then popped higher. And a few guys got in. Down again. And yeah, we have again the double bottom concept. Only it's just, we looked at it from the top side last time, the bottom. It is in this section of trading that people's wherewithal is tested. A person who buys this stock after this monumental fall is brave. He buys it and it goes up, but then it starts to falter. Now his conviction falters because he thinks that the stock should continue to rise in some kind of non-stop line. He then, being right here, falters and sells the stock, at which point the smart money will come and buy the stock from this person who was actually right in the first place, just didn't have the conviction to stick it out. And once those weaklings have been purged from the share, all of a sudden, it's off to the races. Exactly the same as the other. So remember, no one knows where the bottom of the stock will be. But if you make your call and you've chosen to buy it, don't worry about a little bit of time passing before it becomes a clear victory. This is often the case. Stocks have a very distinct tendency to move in only one of two ways. They're either moving in a straight trend, like this, or they're moving in sideways action, or they're moving again in a straight trend, straight down, boom. Or they're moving in sideways action, or they're moving in a trend. So if you buy a stock and you felt it was a good trade, like for example, had you bought United Health here, anywhere in this region, don't need to know a person's exact weight to know they're fat. Anywhere around here would have been fine. Stick it out. Don't worry. Sometimes it takes a month or two for things to work out. And here's the funny part. The smarter you get, the longer it takes, because it takes the dummies a long time to catch up to you once you become educated on the topic. You can't just expect everyone else to realize your brilliant insight the very next day at your convenience after you've taken the position. Give them time, they'll work it out. Also, new information comes to light. And that will create scenarios where, for example, there was a catalyst at this price point on the chart. It was when the new medical aid scheme rates were announced in America. You know, in South Africa, they also announced new rates. In America, they control those rates. They limit um, they don't really have medical aids in America. Only we have medical aids, but they have like health insurance. And they announced that the caps that they were going to impose on this company for the benefit of the people was not as low as expected, therefore allowing this company to have higher profit margins perceived in the future. And that then resulted in a repricing. It's called a re-rating. So it's boom, straight up. Remembering that every single one of these candles is a week. So United Health has just been weeks and weeks and weeks of profits. And it's a good company paying a dividend, etc. Now, who knows what's going to happen here at this middle point? That's the question. Tell you one thing. That candle there, but concerning, because it rose all the way to the top and then it lost it all. And it's at this median point. So while I was very bullish previously, let's just sound slightly less bullish now. But it does give you a good example of a stock that can take, I mean, this took a long time to work out. I mean, if you were like really smart and you bought at the very beginning here, you were buying in May 2025, and your victory only really started 332 days later. Now, obviously, we'd hope to do a little bit better than that for the purposes of this competition, but the idea remains that you don't have to be right straight away to be right. There is no difference between buying it here and it's shooting up here. It's literally the same exact thing. There's only one thing that differs. There's time that passed between them. That's it. If you canceled out this entire section of the chart and you just plugged this thing in over here, same outcome. But a whole bunch of space in between allowed a whole bunch of people to do a whole bunch of stuff they really shouldn't have been doing. They should have just left it alone. And there's a whole world of trading that goes on here. You can make money out of this. You could have made money out of this pop. Now you're in a trading competition, so it would be wise in the case of this to make a quick, relatively quick exit. You don't want to go and try to ride the full extent of the trend in every case, because you'll probably end up having a lot of these scenarios where you just go up, up, and then boom, down again. Now you don't want to lose that. You want to bank at least some of what you've moved forward, unless you feel like you've got a trade that's really in the news and it's for positive reasons, and you really did get it at a discount, a genuine discount in your opinion. I thought I'd look at SpaceX just for the joy of trading. It's not on the Dow, but it is on the NASDAQ. And we did reference it last week. So you can see it's been pretty catastrophic for the astronauts. We were talking about it over here, and it's had a shocking week. Just thought I'd bring that to your attention. So certainly a very interesting trade. It wouldn't probably be very appropriate for this competition, but gives you a sense of exactly how much these stocks can move by. And this is a massive, massive, massive multi-trillion-dollar company. And it lost 46% of its value over the course of 2 weeks. So the market's not a playground in the sense that it is a game in a way, but it's never underestimate the extent of the moves. I bring it up in the case of Microsoft because it's within the competition term periods. I bring up SpaceX because it is a movement that could catastrophically affect your portfolio in a short period of time. And it is the kind of share that people would have high conviction in if they were the kind of person to buy it. You can change this around quite nicely. You can make no group, so it'll get rid of the sector section for you. You can look at the performance for 6 months. You can look at the performance for 1 month. You can get a sense the fact that you can see Nvidia's had a fairly good 6 months, but over the 3-month period, it's done 1%. 1%. So you're going into Nvidia and you're thinking, hey, it's Nvidia, it's the greatest stock of all time. It's been going up by a gajillion percent the last 10 years. Jensen Wang, awesome, my euro, and you've got 1%. Now, that's not a loss, but, trust me, if you're the kind of guy who buys Nvidia, you weren't expecting 1.4% for 3 months of your lifespan. And they probably weren't looking at Apple, and that's where it happened. And maybe they were even looking at Microsoft, and down it went. Yeah, you can see Amazon. What about this 1 month? See, the market hasn't had a very good month. Nvidia is a nothing burger. Apple's done okay, but okay, good month for Apple. They did announce price increases though. Google, not great. Microsoft flat. JP Morgan. Okay, so what you really want to do when you're actually choosing stocks for the competition is it would be better to choose stocks that have gone in an extreme direction for a period of time. You wouldn't want to buy, you got to win this competition, you got to win it quickly, essentially. You don't have all the time in the world to let the fundamentals and the clever, free cash flow generation, etc., to run through the business system. And everyone's eventually going to acknowledge that, Walmart's a fantastic business and shouldn't have sold off 8.29%. But will that give you enough momentum to make a winner of yourself in the competition? Let's take, for example, Apple. So you might look at Apple and say, hey, it's run 25%. It's clearly the leader for the year in America. You'd be right. So now, what do you expect? Another 25% to happen to this $4.9 trillion company? Like, is that the expectation? That just thinking about the actual size of the company as well, like, is this company going to increase by 25% again this year? Where are we? We're there. Where's 25%? There's 25%. So, okay, it's possible, but it would be pretty out of the trend. Like, this company sort of has a trajectory of value accretion, which is very respectable, okay? But are you going to now get to like that point in the chart in the competition? Okay, what is the chances of that happening? Well, they'd have to do something seriously, seriously cool to see that happen. Now, let's just give you an example of, we'll just use Nike again, the dog of the Dow. Okay, what do we need to happen to make 25% on this one? Okay, now doesn't that look a little bit more reasonable to you? Like, look here, for example, let's move this 25% here. What is this? 51%. What is this little move? 23%. So the reason I show you this is because it's not this move that's going to win you the competition. Not this big move here. Not this big move. Not a chance. This isn't a long-term investment competition. It's a trading competition. It's these moves that are going to win you the competition. Now, the thing about these moves winning you the competition is that they only happen after these moves. Yeah. So in order to make money in the stock market on a short-term basis, you have to practice some mean reversion style thinking. It's not just about pure fundamentals, and it's not even about support and resistance levels at the term of the competition. You want to buy very sold off stocks and sell them relatively quickly after a mean reversion. And the heat map will really help you do that because it will tell you over every term. You've got probably a better chance of utilizing some of these assets. Again, United Health, as much as I did enjoy it, it is now a monumental company that we're looking at here. If we go back to them, a $380 billion company. So it's not anything close to the IT style companies, but other than IT companies, this is about as big as it gets. Your oil companies like Exxon and stuff, these are in your sort of $500 billion regions. So this is a massive company. It makes a net income of $12 billion, for example. But would this stock be able to do what it did previously again? Maybe, but I wouldn't bet the house on it doing it again as quickly and easily as it just has. That part of the journey, the second part of the journey, is far harder than the first. It's harder for the stock to achieve. This bottom part where you bought when you bought the pain and you bought the misery and you bought the negative sentiment, that's the hard buying, but the trading afterwards gets easy. You just end up going up and you can just look at your money and count it every day. Whereas these guys are going to have to take some serious risks. They face the prospect of moving all the way back down again or just going sideways. Maybe we could have some kind of correction in time instead of a correction in price. Maybe the share just consolidates at this level and goes sideways and wastes, you know, a year of the lady's life after she buys it, and then only then does it move higher. Okay, cool. Whereas having bought it here at these lows, especially on the double bottom low, you'd be pretty sure that most of the people have had the opportunity to sell the stock by now. This entire generation of individuals, stock owners, would have had the opportunity to sell it. So that removes most of those people who are wanting to sell it. Then you get the new entrants who are looking at the news and getting very interested in it and taking a more active approach. Some of them are selling, the ones that have bought previously, some of them are buying, and a few of them left over, and boom, up you go. But this section is always the hardest because any percentage point that a share is risen by is another percentage point that it can fall by. And it's also a percentage point it's taken back. And it only has to take it back once. The market could take it all the way down again. You never know. Could take it all the way up. It's just a far better risk reward having done it after such substantial selling to get your entry in at that point. Here we've got a lot of muddied waters. We've got a lot of selling that happened previously, but for the most part, those people are gone. A new generation of people are now in the stock, and you've had a new rally. So you just can't be as convinced. Still a good company. JP Morgan, large investment bank in America. We'll just cover one bank because we're running out of time. Hey, these guys, you know, are overseers, people who run the planet. They come out with some great earnings. Also a fantastic company, but yeah, you can see a long rally followed by what could be a dump, and now new retail hands have purchased it going into its earnings, and up we go. So not quite sure about this one myself. I don't own it, but brilliant business, brilliant model, incredible company, incredibly powerful company. Let's see how financials go in America. Walmart, WMT, also available for purchase on the competition. Here's a good one. Okay, so yeah, you've got a pretty powerful company. Pretty obviously, everyone knows Walmart, even if you've never been into one. They owned Massmart for a while and they exited. So it had a very good run over the course of the last, decade. And then it had a horrible candle on its most recent set of Q1 earnings. And down we go. So it is a great company, but just be careful because having run up so much, if there is some kind of trend in that sector that's resulting in what could be maybe a little bit more of a sustained problem, then, if you have such a long time of good, can you have such a short time of bad? That's basically just the logic. There's no real reason for me to say that. The stock could end up bottoming at the old high of 105. Be a good trade maybe, but should it break down below that, there's a lot of room to fall if things are in fact going wrong there. I happen to know that the family that owns this company has also sold a fair amount of its stock in the recent past. Okay, 10:30. I must Stop. Last time I went too long. Thank you, Emrys. God bless you and have a wonderful Saturday, and we'll speak again soon. It's earnings season. I just want to give you one last thing quickly. This is all the earnings that are coming out, or these are all the earnings releases that will be coming out over the course of the next couple of weeks. You can just screenshot this. You can see here that this is the week that just happened. We received earnings from Netflix that I discussed. Travelers had earnings come out. Also, it's one of the Dow constituents. Have a look at it. It was a very good set of earnings. ASML, making lithographs which make chips, Johnson & Johnson, they all came out. United Health came out. It had very good price reaction to its earnings. Then this is what's going to apply next week. We've got things like 3M, which is also on the Dow. We've got large companies. There's IBM. There's Honeywell's also on the Dow. And we've got some seriously big companies coming out there. Then the following week, we've got Visa. You know, these are also Dow companies, absolutely massive. Microsoft, Dow company. We've got Amazon's a Dow company. So you've got a number of these companies coming out next week or the week afterwards. So this is the beginning of earnings season that's just passed, and now for the next 2 weeks we're going to get the big boys. So it will be such an interesting and dynamic time. But do me a favor, before you buy anything, just have a look at this and just be sure that you're not going to be surprised by some news announcement that's going to happen tonight, because you could just find you get a bit blindsided by the fact that the earnings came out and the day you buy it, the stock does something very interesting, maybe for or against. But I'd still rather you knew that these things are. You might also wait for them to announce their earnings, and if you felt that there was an overreaction to their earnings, it would then give you an opportunity to take those positions into those stocks that have suddenly dropped or suddenly risen, and you can maybe sell more quickly, or it might be the reason why you wanted to sell and bank the profit, or enter the stock in the first place. So keep in mind that that's also going to be in play next week, and it can be like a way you use it as a catalyst to get what you want. Okay, cool. Have a great time, guys.
Thank you so much, Michael. We will be concluding now. Thank you guys all for joining us. I will be distributing the video to everyone. Again, check us out on YouTube just so that you can be updated for new videos. All of the best with the competition. Please drop any questions you have into the form link that you've been emailed, and have a blessed weekend. Thanks, everyone.